Welcome to the deep dive. We're jumping straight into a fast-track analysis of 6 key reports today. We're going to connect the dots between some pretty dazzling corporate performance, hidden market risks, and what the Fed might do next.
Exactly, and that's our whole mission here. We're looking at a market that's just full of contradictions. You've got these record earnings on one hand, but they're hiding some really serious structural warning signals. The goal is to pull out the key insights you need to see the fragility underneath it all.
Okay, let's get right into it, starting with this first source, the earnings scorecard. I mean, the surface numbers are just incredible. 91% of the S&P 500 is reported. 82% of them beat EPS estimates.
Yeah, which is way above the 5-year average of 78%.
And the blended earnings growth is 13.1%. That's the 4th straight quarter of double-digit growth. It looks perfect.
It looks perfect for Q3. But this is where it gets really interesting. While the profits are soaring, the valuation metrics are historically stretched. The forward PE is up at 22.7. And the Shiller P, which, smooths out earnings, is near 40. We've only really seen that during massive bubbles.
Yikes. So the market is priced for a perfect future that might not actually happen.
Precisely. And the immediate red flag is that 58% of companies issued negative Q4 guidance. But here's the biggest structural piece. If you take out the massive capital spending from hyperscalers on data centers, U.S. GDP growth for 2025 is estimated to be just 0.1%.
Wow, just 0.1%. So we're basically paying for the whole economy with data centers.
It's the entire narrative right now.
That sets the stage perfectly. Okay, let's pivot to the company everyone's watching from the report titled Price to Perfection. NVDA, revenues are up 62% year over year, net income up 109%. I mean, those are just dizzying numbers.
The growth is real, no question. But when you look under the hood, you start to see the strain. Inventory surged 96%.
Wait, 96? How can inventory nearly double if sales are surging like that?
That's the key question, isn't it? It suggests their clients may not have the ready cash to pay. So NVDA is forced to act like a credit card, basically financing these huge purchases for its customers. They're selling chips on layaway.
That's a huge risk.
It is. And it ties into criticism about their amortization practices, where they claim older chips have these really long, useful lives, even as new models come out every year.
So if corporate balance sheets are starting to look like lenders, what's happening in the actual credit market? Let's move to split worries.
This is a classic first shoe to drop signal. We're seeing this really worrying split in the junk bond market. The price difference for the absolute riskiest bonds, the BCCC-rated ones, has sunk below its April lows.
Meaning investors are demanding much higher returns to take on that risk.
Exactly. Liquidity is just vanishing at the low end of the market. It suggests a system where only the top-tier credit is seen as safe.
And that kind of domestic tightening brings us to a huge global story, the yen carry trade. For decades, this was so simple. You borrow yen for almost nothing and invest it in high-return U.S. assets.
It was a machine.
Yeah.
But what's so fascinating is that the machine is shutting down. Why? Because Japan finally has inflation.
Right, so their interest rates are going up.
Exactly. The rate difference that made the trade worthwhile is disappearing. And as the trillions of dollars in this trade unwind, it causes these ripples, like U.S. markets all falling at once.
Absolutely.
We might even see the Bank of Japan start selling U.S. treasuries to buy their own bonds.
Speaking of rates, that brings us back home to the Fed. Let's look at the governor's speech. Governor Waller argued pretty forcefully for a 25 basis point rate cut in December.
He did. He's clearly building his case to be the next Fed chair, putting that dovish stance out there. He's pointing to weaker labor demand, low consumer sentiment. But the market isn't really convinced a cut is coming, not without Powell's word or, a major crisis.
But his argument just got a lot of academic cover, didn't it? That's in our last source, voila. The San Francisco Fed reviewed 150 years of tariff data.
And their conclusion gives the Fed the perfect intellectual framework to cut rates. They found that tariffs are actually deflationary and they increase unemployment. So the Fed can now argue they need to act fast because disinflation is already baked in and the labor market could weaken very quickly.
Okay, so let's tie this all together for you. The big takeaway is that the underlying economy seems far more fragile than those great Q3 earnings suggest. We're seeing these structural risks, 0.1% real GDP growth, stress in the credit markets, and this huge global pressure from the yen carry trade unwind.
Which leaves us with a really important question for you to think about. If the Fed does go ahead with the rate cut, using this new tariff and deflation argument, will that be enough? Will a domestic policy move be powerful enough to counteract the massive systemic unwinding of the yen carry trade, or are those global flows just too powerful to stop?